Chapter 6, Depreciation. The following forms and publications were used in the research and development of this lesson. Forms and publications are available at www.irs.gov. The objectives of this chapter are for the students to identify the different class life for personal and tangible properties, recognize the difference between real property and personal property, understand the difference between intangible and tangible assets, comprehend that land is never depreciated, and associate that depreciation is an annual deduction. What is depreciation? Simply put, it is the annual deduction that allows the taxpayer to recover the cost or other basis of their business or investment property over a certain number of years. If a business purchases a car, as an example, for $10,000, they would rather be able to expense the complete cost in the year purchased. What the IRS has done is established specific items. For instance, a car bought for business cannot be deducted in the 1 year. It must be spread out over 5 years in this example. So they have designated for the length of time, and depending on what property was purchased, the length of time that you must spread out this expense. And understandably, generally speaking, a business does not purchase cash for a car or large expenditures, but rather have a payment set up over time. So there's the idea. You didn't actually spend it all in the 1 year, but went over time, usually 5 years. Therefore, that's the idea behind depreciation. It begins when a taxpayer places property in service for use in a trade or business or for the production of income. The property ceases to be depreciable when the taxpayer has fully recovered the property's cost or other basis, or when the property has been retired from service, whichever comes first. There are a variety of types of property. We identify them under the category of tangible, intangible, real property, and personal. Tangible, simply put, something tangible, something you can touch. Perhaps a copier. When you buy a copier for your office, that is a tangible product. Intangible could be a song you wrote and you copyrighted. Could be in a software you developed by itself. It's not something you can actually touch, but it is a form of property. Real property is businesses, land, homes. That's considered real. Think of the word real estate. So real property, as opposed to personal property, jewelry, other items like that. A computer, considered personal property. Now, basis is the name for how much you paid for something. The example, the copier I mentioned. You bought a copier for $1,000, but that would not be the only cost. So basis is generally the amount of the investment in a property for tax purposes. The basis of property is usually its cost. If I bought the copier for $1,000, there's my cost. There may be other costs involved in getting it ready for service, and that's the key. The cost is the amount you pay in cash, debt obligations, or other property, no matter how you purchased it. Cost also includes sales tax charged on the purchase, freight charged to obtain the property, installation and testing charges, excise taxes if there are any, legal and accounting fees, revenue stamps, recording fees, real estate taxes if assumed by the seller. So everything that you spent to get that copier ready to work for you and starting to work. There's also a situation called salvage value. Now that's used in conjunction with the purchase price and accounting method to determine the amount by which an asset depreciates each period. So if you have an X amount of value on something after the term of depreciation, that's considered salvage value. Now, it is ignored by the current accelerated cost recovery system, or ACRES, and modified accelerated cost recovery system makers' rules, but is relevant in calculating depreciation on assets acquired before 1981. So in many times with your clients who do have a business, you won't be worrying about calculating salvage value because it's been since 1981. Land can never be depreciated. So certain costs incurred in preparing land for use can be. For instance, putting a slab down for a foundation. These costs are closely associated with other depreciable property that a life can be determined for the costs along with the life of the associated property. But usually in a property, you would subtract the initial value of the land from what you have to depreciate. Now there are a variety of methods of depreciation. The depreciation method that is used for any particular asset is fixed at the time the asset was first placed in service. Obviously, if you buy a copier at the beginning of the year, you're going to have more depreciation for that year than if you bought it at the end of the year. The owner needs to apply whatever rules or tables are in effect for the year that the asset is placed in service, and that method is used throughout the life of the asset. So in the final year, if you purchase that copier in December, you're going to have a small amount of depreciation to deduct that year. And of course, that will give you a fifth year or an additional year after the correct amount of time to completely depreciate the balance. The owner needs to apply those rules in whichever way for that year. The depreciation methods have changed over the years, and there are three methods that are used to determine how to figure the depreciation. The method used is determined by when the product was placed, not purchased in service, and the type of product. It's been found, and what you usually see now is the mid-year or half-year method, which you just assume anything purchased, you bought a half year, that will determine a good average amount for the first year and the remainder of the life of the depreciation and the life of the product. There's another item called listed property. Now, listed property is property that the IRS has determined to be abused by taxpayers claiming business use when it is really used personally. For instance, automobiles. You buy it for business, but it's a partial. You only use it partially for business, otherwise you use it for personal use. It's very critical to keep accurate records and separate the business use from the personal use. Another is cell phones, that perhaps you use the same cell phone number and cell phone for business and personal. And to be able to clearly separate those is absolutely vital. And items considered listed property must be listed on the second page of Form 4562, Depreciation and Amortization. Just know the IRS looks and scrutinizes more those listed property, and it's important to keep more accurate or as accurate records as possible for those. Recovery period. Now this is a term for how long the IRS places any property item that they determine must be depreciated. Typical, 3 years there, and there's a full listing that if you look up under the IRS rules and the appropriate publications, you will see the listing of all the different types of property that qualify under 3-year or 5-year, 7-year, all the way up to 27.5 years. Generally speaking, when you're doing taxes for clients who have depreciation, it's usually 5 years, which includes cars and computers and copiers, any other type of equipment like that, or 7-year for business furniture. And you also will find for rental houses 27.5 years. These are the more common items of depreciation that you will encounter. Now, it is also important to understand placed into service. So it's not an issue that I bought a copier and I have it. It's an issue of when it is ready to be used for business or placed into service. So it's possible I bought the copier in December, but I don't have it up and running until January. So it's based on when it's placed into service, not just when I bought it, and therefore all expenses are inclusive to determine depreciation. The property is considered to be in service when it is ready and available for its specific use, even if it's not being used. So it's ready to use. Did I need to make a copy that day? No, but I could have. Amortization is a method of deducting the cost of an intangible asset using the straight line method. You will learn more about what is straight line method and what is double indemnity methods. The straight line method means an exact same amount percentage depreciation every year, as opposed to other types which might make for a greater amount of depreciation at first and a smaller amount later on, such as with automobiles, because they go through more depreciation, lose their value quicker in its first part of its life. Goodwill and patents are examples of property that would be amortized. Refinancing could be a form of amortization. As you refinance any loans based on your business, that additional then, that is an amount that you would be able to amortize over a longer period of time. For tax years beginning after 2005, the taxpayer can elect to amortize certain capital expenditures paid or incurred in creating or acquiring musical compositions and copyrights of such compositions instead of using the income forecast method. More research would be needed if you get into that type of tax returns to learn the definitions of these. Amortization will not be discussed further in this course. Additional research should be done if more information is needed. Please look at publication 946, How to Depreciate Property. Section 179 throws another little monkey wrench in depreciation. Clearly, the best I recommend and what I do in my class for depreciation is I begin with the tables. There are specific tables set up by the IRS based on what property you have purchased, the recovery period, and the particular method used for depreciation to give you the fixed percentage to apply for any given year on depreciation. Having those charts makes it very easy to calculate the amount of depreciation that needs to be deducted for any given year. One of the other options is Section 179 property. That was property acquired by purchase for use in the active conduct of trade or business. Section 179 of the Internal Revenue Code allows the taxpayer to elect to deduct all or part, subject to limitations, of the cost of certain qualifying property in the year it is placed into service. Real property can never be Section 179, as we call it. The taxpayer can do this instead of recovering the cost by taking depreciation. So it's possible that you purchased a car cash for $10,000 and you use it completely for business, and you don't want to depreciate it over 5 years. As long as it falls under and is subject to the limitations, you would be able to take that full expense in the year incurred under Section 179. Once the election has been made to use Section 179, it cannot be revoked without IRS approval. The IRS will grant approval only in extraordinary circumstances. Now, when a business is sold or an asset of a business is sold, any gain on the disposition is generally recaptured as ordinary income up to the amount of the special depreciation. Excess business benefit needs to be recaptured as ordinary income. If business use falls below 50% for an asset, which is listed property, and Section 179 was taken, the deductions will need to be recaptured. And an easier way to try to understand that, if I bought a car for $10,000 and I depreciated $5,000 of it and sold it, I would have to back include the part that I depreciated and include it with the basis, before subtracting to see if I lost money or made money. And it would normally mean that you then pay tax on the income of the difference. Now, Form 4562 is used to report depreciation expense. In Part 1 is where you elect the Section 179. So I bought my car this year. I want to take the full $10,000 instead of depreciation. This is where in Part 1 I would elect the Section 179 and choose to take that expense all at once. Part 2 is where depreciation deductions are listed. Well, I shouldn't say that word listed, are recorded, placed in service during the current year. Part 3 is where you put depreciation deductions that were placed in service before this year. You're just notating the total amount of depreciation being taken when it's a property purchased before the current year. Part 4 is summarizing other parts. Part 5 is reporting the depreciation on automobiles and other listed property. And Part 6 is where you report the amortization deductions. There gives the full detailed that then goes and is reported on Schedule C or Schedule F and possibly Schedule E. There are many variety places where you can report depreciation. Interesting too to keep in mind, especially with real estate, depreciation will be focused more in sole proprietor and other sections, but depreciation is something that may need to be recaptured whether it was taken or not. So be aware for your clients, if they have some kind of property that should be depreciated and it's not being shown as depreciated, they may want to and consider placing that amount in and keep up with it, because depreciation, whether you have to recapture it or not, the IRS classifies it as allowed depreciation or allowable, meaning whether it was actually taken as an expense or not, when you sell it, you still have to recapture the equivalent amount. That covers the information at this point for depreciation. Be sure to complete Chapter 6 review questions and TPAs and read Chapter 7 for the next time. Thank you.